Okay, this is part 3 of the analysis of the M&A. And again, just to remind you, uh, what I'm doing, what I'm doing is reviewing online class we had, and I promised the participants that as well as receiving the as well as receiving the videotapes and all the rest of it, as well as receiving those, I would make a summary video of what we've gone through. So this is part 3. And in part 3, I'm going to describe how we can take if we want to get the valuation of a transaction, how we would make in a merger. We can do two things. We can, number one, we can put in the consideration and put in some assumptions for our debt assumed and for the what we do with the cash. We arrive at a normalized EBITDA. We can back into a multiple to get a target. I hope I put this. Did I put a target IRR to get a target? And when I say target IRR, I'm going to call it the target equity IRR. Okay. Now, if I would have been a little more detailed on this one, what I tend to do on this one is just use this as an example to illustrate some financial modeling ideas and some ideas on how to make the flags a little bit flexible. But before we get into the model, let's go to our uh, implied valuation from our LBO, perhaps, okay? And let's just discuss things. So I just have a little discussion of what an LBO is and what happens when one group takes over the other. And the big idea here, a lot of the idea centers around how much debt you can raise for the buyout. And I guess I'll stop. I'll give my little typical speech, which I give over and over and over again. If you have somebody from outside, not inside your company, if you have somebody from outside of your company looking at this and looking at the risks of the transaction and putting a lot of financing into the transaction, and they say, okay, it's like a stamp of approval. It's like a stamp of approval. You've got somebody from outside the company verifying that this is okay. Okay, so here's kind of how we're going to work through this. We're going to put in a target IRR. We're going to put an entry EV to EBITDA ratio again. Do you remember, I hope, that when you go through this theory of the EV to EBITDA ratio, that EV to EBITDA ratio is driven by taxes. It's driven by the tax rate. It's driven by the asset lifetime. It's driven by the growth in earnings. And just taking say target equity IRR. Okay. We're going to start with the target equity IRR. We're going to use the ideas of synergies. If you cannot increase the EBITDA, if you can't do anything to reduce the operating costs or increase the revenues or even reduce the capex, you're not you're probably going to enter at one EBITDA, exit at the same EBITDA, and in between not really do much. You're not going to get much. Maybe you'll get a little bit actually from the debt. Okay, so uh, when we compare the LBO method to the TCF, it's really a lot of the same. The only difference is, look, we're backing into the entry EV to EBITDA. That's backing into the value. Okay, and we're using a target IRR to do that. It's like going the other way and using the WACC to figure out what the value is. And we're having a terminal value. We're having instead instead of an explicit period, we'll call it a terminal period. Instead of a I'm sorry, explicit period, we'll call it a holding period, and then we'll have a terminal period and an exit period. It's all very much the same, okay? One difference is we don't have to worry about the WACC. We're just going to throw in IRR. Now, the question is, what kind of IRR should we throw in? How much debt should we do? And we're going to use this LBO, even if we're not really doing an LBO, we're going to use it. Okay, so to get this model built, we have to put some debt in here. Typical ways you might do the debt is you might put something with the debt to EBITDA ratio. So you might take 3 times debt to EBITDA, 2 times debt to EBITDA, and so on and so forth. Okay, I'm going to skip this one and a couple of others here. All right, when we develop this since everything is tied to our wonderful EBITDA, but remember, what a stupid laugh I just had, sorry about that. When we have this EBITDA, remember the EBITDA is different depending on how much capital expenditures and taxes the EBITDA has to support before you can start paying off the debt. EBITDA is a nice, simple kind of calculation, and you can see that it's commonly used because you don't have to worry about interest, taxes, and depreciation, all of which can be adjusted and changed. But at the same time, different kinds of companies have to have different levels of EBITDA to support their investments. Okay, so then I collected a couple of these slides. Now this says that in the let's see, the high quartile of funds made 23%. That's a fantastic IRR. Equity IRR, though. And then other median funds made 16% compared to these returns on the stock market. Maybe this 11% and 13%, that's the median. That might not be so good. And remember, you don't exactly, I think, figuring out what this IRR really was, you have to go back to when the leverage buyout was done, and all the market conditions could have changed, the tax law could have changed, everything else could have changed in between. This is a much older one, and again, it shows the buyouts making something like 15%, venture capital making higher returns. Now, if that was really, really true, and if you made that without taking the same risk, you would think everybody would go into venture capital and everybody would go into buyouts, and you'd eventually get the returns down. Again, remember, this is from a whole different kind of thing. If you're making way above the overall earnings on the economy, there's something a little bit funny going on. Okay, and it depends. All of these measures of return from different types of instruments depend on when you assume the start date is and end date is. So you've got to, I think, take them with a little bit of a skepticism. Just to get started, we're going to be talking about EV to EBITDA, and it just irritates the heck out of me to say that we can compare one EV to EBITDA from one industry to another. It depends on the potential growth, the lifetime of the assets, the tax rate. I've said this over and over again. So computing some kind of average is kind of meaningless. It could be the fact when these go up, especially if this is, I have no idea if this one, it's not my chart, it says USPE. In the US, there was a major tax reduction. Now, if you start with 100 and you used to pay 35 tax, now you pay 21 tax, after tax, your earnings are going to go up by a really big percent. And that means your enterprise value should go up like that, unless you have to give some of the taxes back to your consumers, which doesn't seem to have happened. So your earnings go up by 21%. Your EBITDA could stay the same, and your EV to EBITDA ratio will go up, and that can explain in part what's happening here. Maybe not, but it's an easy one. And then we have all these other multiples. Again, mean almost nothing. This one's kind of interesting that now smaller companies are getting a higher EV to EBITDA multiple than bigger ones. So much, this is an older chart when it wasn't happening. So much for this bizarre small company premium that the EBITDA of a small company is worth a different amount than the money you take in for a small company is worth less than the money you take in because the small company is somehow more risky or maybe you have more control over them. This shows that there's just an enormous really range. This says here are all the EV to EBITDA multiples greater than 30, 30. Here are the ones between 15 and 10. Here are the ones between 5 and 10. And there are some, I guess they had negative EBITDA. And these ones that have almost no EBITDA, maybe you're buying whatever, a company and hope to really fix it up. Okay, so those are there are wide ranges. In the old days you would see these really high ones, maybe more typical these. Okay, so it does show you that they're going up. Okay, and I already talked about the asset life too much and all of that. And this shows you the different kind of levels of debt in the EBITDA. How much is the equity put in? Might be about 40%, and then we have some senior debt and some non-senior debt. For our exercise, I just used one debt issue. I didn't get all fancy, but you could get statistics about about LBO. Some of it's a little bit old, and some of it's better. Earnouts is when you don't put all the money into the project. It's an easy thing to model, and once you've hit some kind of target, then you'll contribute more of your equity into a deal. That can be an interesting way to limit risk. And then I have some general characteristics. This is a J curve that says, let's find the optimal time to sell when we think the multiple will be highest and when we're not holding on to money when the EBITDA will start to not grow quite as fast. This is this horrible question about whether private companies sell at some kind of discount, again, saying that money is worth different when it comes from a private company than a public company. There were all these arguments about audits and so on and so forth. They're not, for me, very plausible. Maybe you get a little bit better information to get a little bit of a little less risk, but to try to put science on some of this stuff seems absolutely absurd, and try to say that we should make some kind of arbitrary kind of pricing adjustment. And this says that this gives, it's an ancient history, but it gives kind of the pricing. This was 200 basis points or 2%. And you can see that the pricing of the loans, it started to go really high, but around 2006, and that's ancient history, it was pretty low. Okay, and then it gives some more statistics. All right, so now let's go to our model. So when you're modeling an LBO, one of the things you can do, it's centered really around this EV to EBITDA ratio. That's why in part one of this analysis, this discussion of the EV to EBITDA ratio, I kind of even put the EV to EBITDA here again. And I hope you remember that when we change something like the lifetime of the assets, that has a dramatic effect on the EV to EBITDA ratio. If I put my formulas in here and make sure that we're on automatic, and this is the wrong sheet. Excuse me for that. I'm going to keep going. So what we can do now is we can say, here's our consideration. Now this consideration, together with a normalized EBITDA, when you take out, okay, what's the cost of auditing a public company or something like that? You take all of you make some kind of standard and seemingly kind of pretty obvious normalization adjustments. You don't necessarily make a normalization for a typical year or something like that, or if we're in part of a business cycle that's different. You don't do that. And then you can assume all of the debt, or sum of the debt, if you do assume sum of the debt, you've got to put that into the analysis. So for right now, I'm going to put 0, that we don't assume any of the debt. Our consideration is just the amount we pay for the company. Okay, and then now, oops, we have a transaction multiple of, okay, now I find this, I've done this too many times, and it's a simple case, and it's the simplest case I've done many times. And some people find that just going through this very simple case is helpful. Now, I don't have, just got to tell you right now, I have a tax assumption here. I'm putting no tax assumption at all. And I'm assuming now that we buy a company, and when we buy a company, we pay for the equity of the consideration, for the equity. So I'll put even consideration for equity. And then we perhaps have to either assume the debt, or better yet, I'm going to say we're going to have to retire all the debt of the company. But we have to pay for that. And if the company has cash, it'll probably take it out as dividends. So you'll have one of these transactions, the value of the company without debt, without taxes, but we can compute the enterprise value anyway. And I'm just going to leave the cash there for now. And I just told you about the taxes. Now the holding period, okay, be a little consistent here, hopefully, with some of your units, you know. And for the holding period, we want to make that really flexible. That way we can see, we can delude ourselves into thinking there's some sort of optimal holding period. But it is true, when you really think about this, it is true that we can hold on to this and we don't have to sell it. We can sell it when we think the market is really good. We don't want to sell it the day after the market totally crashed. So I don't know how many years I forgot how many years I put in there, but we can sell it at any time we want. We go back to the back and forth, and we click on this one. So let's see how many years, what was our maximum years? Okay, I put 20 years. That sounds about right. And my computer is going really slowly. I didn't want to do that. What I wanted to do is just be able to change these. And this should really be taken from our holding period. And so we can evaluate the rate of return we're going to earn. The whole business, I should have really talked to you about this, but I did show you those graphs, which we see what kind of target returns you really want. And perhaps people are really making these kind of returns. And if you really think about it, if there's a small group of investors making, it's not maybe it's a large group of investors making all these enormous returns and getting really rich, where is all this money really coming from at the end of the day? Is it coming from efficiencies? If it was coming from efficiencies, you'd see a big increase in the GDP. We could get all very philosophical about all of these things, and I think we should. But I'm not going to right now. Right now, I put an EV to EBITDA multiple. Once we put the EBITDA in, I just took that amount we're paying for the enterprise value and divided it by the normalized EBITDA to get this EV to EBITDA. What's reasonable and what's not reasonable, that should really depend not just on those horrible comparable analyses. It should depend on you really thinking through what are other companies earning in the future. I'm saying this too much, and then we can put a target equity IR. Let's put one of these 22%, really high return. And then what we can do in a minute is do a goal seek. Now the whole business, your whole business, and we could have made a scenario analysis for this. Your whole idea is to put an EBITDA projection in, and in this case, I assume that you get some, you put some EBITDA in, and I assumed that in the very first year you had to make some capex, and I assumed up here that the EBITDA actually went down in the first year. This is all this synergy business. And really, at the end of the day, all of these valuation methods are doing the same sort of thing. And I really think even I'm a little bit of a hypocrite now, but we should have, before we started modeling this leveraged buyout, we should have looked at the history and we should have evaluated what kind of rate of return on invested capital is this company really earning. Now, just like you, what kind of exit multiple relative to the entry multiple is a gigantic deal. If you think about it, you want to pay, you should be paying a really high multiple to enter because everybody should be knowing that you are going to get a really high growth rate in your rate of return. It's all of this stuff. We were looking at it at the very beginning in our first session. In our first session, EV to EBITDA ratio. When this ROIC goes up, of course the EV to EBITDA will go up. And if you can grow it at the same time you get a good return, of course it's going to go up. And then I keep saying, of course, maybe that's not so, of course. When I look at kind of how people say they do some of these analyses, and when I look at some of this survey business, I'm sorry to go kind of back and forth. They say, here's the Swiss company, the professors. They said the most popular multiple is EV to EBITDA. 84% said they use it. How could you use it without really understanding how it's affected by the asset life and the change in the ROE? And they said that the investment bankers like PE better, and so do the people who manage your money. And then they said EV to EBITDA is popular among whatever investment professionals. And then they say, here's what people do. They're so naive. They just kind of throw in some Bloomberg stuff without saying, is this company earning the same return? Is it growing at the same rate? Does it have the same tax rate? Does it have the same growth rate in the earnings? All of these things. This is what I'm really trying to harp on you to to think a little bit more advanced than just doing this kind of stuff that I'm doing right now, which is just kind of putting some numbers in. Now, the investment bankers will argue, okay, I know in theory maybe this one should be higher than this one, but here's what we're going to say. We're going to say the risk has gone down. You've de-risked the company. You've put a new strategy in, and so now somebody's going to pay a lot because they have a nice, really boring old company, okay? Maybe, okay? Maybe you can do something like that. But we really need to know what it is. And then the other thing, it's a little bit arrogant, but I've heard this so many times now that people have an idea of who they're going to sell this company to after they clean it up and they know exactly what this EV to EBITDA ratio is going to be on the other end. Good for them. I don't believe them. I really don't. But okay. Okay. So what we're going to do is do a little analysis of what kind of IRR you're going to achieve. So, when I criticized people for not looking at returns, well, they do look at IRRs. They do look at IRRs, okay? I'm not saying that. But then really focusing on a lot of where does this IRR come from? What's the return on invested capital? That's a little bit less. Now, this is what I didn't do in the class, and one of the reasons the primary reason to make this video is just to clean up some of the stuff I didn't do really appropriate in the class. In just about any transaction you're going to do, I don't care if it's a leveraged buyout or non-leveraged buyout or a consolidation. When we did our accretion and dilution analysis, we should have started really by putting how much money are you going to need and where are you going to get that money? And now as we proceed, I'm trying to do it a little bit more each time. And this time, we'll go and get the consideration first. We'll get how much we spend on equity. And then I said we have to spend some money on retiring the debt. And then we can put some fees in there. Let's throw some fees in here. These would be a percentage, and you might get a little circular reference you'd have to resolve or something like that, which would be an easy one to resolve. And let's put alternate equal to get the total amount. And then let's press Shift Control E to get the underline. And then we can say, okay, part of the place we're going to get the money is we're going to take this cash off the balance sheet. We're going to use that. And then I said, well, let's take 7 times, maybe we should really do it over here. Maybe we should put this 7 over here really to make it very clear what we're doing. And then that's when I showed you, I tried to show you some graphs of kind of what the debt to EBITDA could be for these things. Now, I'm sure if you're a private equity expert or something else, you're not going to watch this video anyway. And then the balance is the equity, okay? And that's what we're going to use for the equity IRR. And it looks like I keep having this percentage number that keeps popping up, okay? And we have our sources and uses of funds. And now when we get a little more advanced, we can take this sources and uses of funds. I better take my grid lines off of here. That's so essential. And we can really look at okay, what are we what kind of assumptions are we making for debt? What kind of goodwill do we have? What kind of asset write-ups do we have? Here's our net goodwill, and we can start our model with a whole new balance sheet and put these in. And I used to be so proud of myself because I could get the balance sheet to balance and do these kind of things. And it's okay. It's not absolutely necessary. I had somebody I remember in Denmark really kind of correct me and say, okay, very good, but so what? And he was probably correct because what you really want, why it didn't fix the name of that thing. Somebody will tell me. Okay, so then now when we do this, how did I do this? I used the interpolate function, of course. I use the interpolate lookup function. Now there's this X lookup function nowadays in Excel, and I'm wondering if Excel will finally come up with an interpolate function because I use it so very often. So what I did up here, I said, okay, we've got in the first 3 years, we got our explicit, and then we'll gradually go up to 500 and then gradually go up to 550. I just really did this so I could remind you how to use it. So it's just a lookup function where we take the whole line we look up this and we take the whole line of fine, I'll do it. Interpolate lookup. Okay, and this one does it with a growth rate. You could also do it with a linear method. So you just take this and take the whole line, just in case you haven't seen me do this a lot. And then I said, okay, well, once we do that, we better also multiply it by the holding period. All right, and then I get this. And then we have our CapEx, and we put our working capital change in, and those are just some assumptions. And we really should, and I'm a little bit embarrassed I didn't do this, we should have put depreciation in here, and we should have really evaluated what the return on invested capital is, but we might not have had the real initial invested capital anyway. And then what the first thing we can do is we can take the total amount of our capital or the total amount of our spending, either one, okay, and then we can compute our net cash flow. And this period 0, by the way, this is the transaction period. And in a minute, not in a minute, in the next video when I go through the DCF, we're going to waste time on making a model here because people asked about a model. And then we can easily make our model go from monthly to quarterly to annually, and you don't be intimidated by this. You just spend a little bit of time. Perhaps you spend more time really on setting up a good, really, really flexible model before you do just about anything else. Or that might be, especially with pandemics and everything else, it might be really important. And then we put our our uh, our exit multiple in. Oops. Okay, and uh, with that exit multiple, we can look and see what our I call it ungeared, unleveraged IRR. We might have a target. Okay, if you're so let me make sure. Okay, so this is our net cash flow. We spend money without, this is before we considering gearing, and this is maybe a little bit analogous to the WACC, which no most people probably wouldn't even put in here. And we could also, I might put up here, we could copy the the spinner box to the holding period. And what we can look and we can see what happens if we hold the project a little more, what happens to the IRR. I'm staring at this IRR. Okay, and if we have a much higher multiple than our entry multiple, then it should be the case that we'd like to get out of it pretty fast. We'd like to get out of it just right when you hit that peak of the EBITDA. Okay, in fact, well, you want to get it out in year 3 or 4. Okay, if we have a much lower multiple, maybe then, oops, that's getting too low. Sorry about that. But that would be the risk of the transactions, and I have to wonder out loud whether some people just hold the transactions if you can't get out of them until it's going up. So in this case, you're the longer the holding period, the better. So you can see that there's a little bit of an interrelationship, and we don't have to get really fancy. Now, if you would, uh, um, if you would, oops, want to compute a target IRR, and basically what you would want to do is see what kind of consideration can we offer for this company. That's really what you're doing with everything. What kind of consideration would we offer for this company to earn a 22% IRR, which is ungeared, which is not the IRR you're looking at anyway, but which illustrates some of the point. My suggestion is always to put a target IRR in, then compute the NPV on that line item that you're going to compute. And once you do that, you just make, of course, a goal seek. I said, of course, again, and then I didn't do it correctly, and I should have done what if analysis and the goal seek, and then you can just always set the NPV to 0 by changing what you want. So if we would want to make that much higher return, then we're doing a valuation. We're doing a valuation. It's not exactly a DCF valuation, but it's really not that different either. Oh my gosh, we'd only spend this much, and our EV to EBITDA would only be 5 times because and we're backing into how much we can spend in order to get this rate of return. That's the only difference. It's really not, it's really all the same, isn't it? And it's really all about understanding the EV to EBITDA. And it's really going to be in a little while thinking about normalizing the EBITDA. And it's really about thinking about the economics of how much you can increase the EBITDA and whether you think that's a reasonable kind of thing and whether that's like venture capital and kind of a very risky kind of proposition, so we need a high IRR, or whether you're just taking advantage of kind of whatever people paying less. Okay, now instead of doing that, now we said no, we're going to put some debt in. And the debt financing comes straight from our sources and uses of funds, it should. Okay, and that, now when we put the debt financing in, I put a cash sweep, and I sometimes get all excited about making a if the interest is on the average balance, we could make a circular reference. I mean, make write a tiny little program to resolve all this, but I don't feel like doing this right now. I just want to get through kind of the interest. And whenever you would work through the equity cash flows and the equity IRR, it's almost, I would so strongly suggest, and it's so obvious to me now, but it didn't used to be, I would so strongly suggest that you should first put a debt a debt schedule in here, okay? I'm trying to say it in different. And then once we put that in, we can take our operating cash flow, which is our EBITDA, really, I think. No. But we got to be really careful. It's our EBITDA minus our capex minus our working capital change. So our operating cash flow better be this thing down here. How about another underline, okay? And then we'll sorry about that. And then we'll take that, and then we have to repay. We better pay the interest off, and after we pay the interest, we can get some cash flow for repayment. And if since the interest is subtracting here, if we don't make the interest on the opening balance, we'd have a circular reference. And then at the very end, we're going to well, I put the excuse me, I put the exit proceeds up here, so it's really that's fine to put them up here, I guess. You'd have to be very, very careful with the taxes, and you'd have to be careful with when you're selling the company. Now we should talk about the taxes just for a minute. If it's a taxable transaction, that means if you're selling an asset, if you buy a car, no, if it's whatever, if you buy a car from a business, typically that car, the person, when you buy the car, you get to depreciate it at the value you paid for the car, and then maybe the tax law says you can depreciate it for 3 years or 5 years or something else. And if you're buying a whole segment of a company, that's the way it would work. And if that's the case, what you would do is you would get to essentially, when you'd get to write up the assets, and essentially you'd get to depreciate the amount you're paying for the enterprise value of the company. You essentially could depreciate this. Okay, maybe not. You'd have to make adjustment for cash and everything else, of course. Okay, but if you're not doing it, if instead you're buying the shares, you're buying the whole company, not a segment of the company, then you can just buy the shares. And if you buy the shares, then you don't get to write up the depreciation, but the person selling doesn't have to pay a gain. It normally would be a much better thing to do to buy the shares and be able to not have the seller pay a gain and you have to wait for the depreciation later on. Okay, so those are the two types of transactions. And when we sell the company at the very end, we'll have the same sort of issue. So when you get into it, you'd have to be very careful for what kind of assumption you're going to make when you sell it. And by the way, I should have perhaps emphasized this. When we go way down here, when we talk about these multiples, when you talk about the multiples and particularly the EV to EBITDA multiple, okay, if you're buying the company, up here they said aggregate value. If you're buying the company and the company, when it sells, it has to pay taxes. You're gonna buy the company at a very different amount. You're gonna pay a lot more for the company if you can write up and take a higher tax depreciation, and then you have to pay more for it to give the seller money to pay the taxes. So the whether it's taxable or not is a big deal. And I'm not putting it in because I just did this whole course to kind of demonstrate some of the points, and you can look all over the disk that I can give you, or look at the um, excuse me, look at the when I said disk, the Google Drive. If you, of course, you send me a little email or respond to that thing I have. We're still on this page, but if you respond to this one, I'm just working on my marketing a little bit as well. Okay, I tried to put this thing up here, and if you click on this thing, I think, and ask for access to the Google Drive, you can get all of this. And just a minute, I have to. So you just would click on this, and you send me the thing, and then I'll give you all the models, of course. Okay, which are a lot of them are on the website anyway. Okay, so but now what we do is we compare the amount of equity we invested. Now, if you only pay this, I'm going to have to put a little more consideration in here. Let's put a lot more. Let's put this. Okay, and once you have repaid the debt, and maybe I should have said that, so we take the debt, the interest rate times the opening balance, and we subtract the interest from our cash flow, and we get how much we have to pay for the cash sweep, and the actual debt repayment is important. That it's the minimum of either the amount we have, the opening balance, or I'm sorry, the opening balance of the debt, or the amount of cash we have to pay. So when we get into our terminal balance period, we only have 1,224 debt left, but we have all this cash flow from our terminal period, and then within minutes we can get a skeleton of a LBO model built, and finally we can take this same kind of thing. We can put the NPV at 22%, and we can put a little a spinner box around there, and we can take our NPV at 22%, this time of the equity cash flow. Okay, and what did I just do? What? Okay, I'm sorry, I got a little bit. 22%. I might have some stuff at the end. I hope I don't. Okay, just 1 second. Now, this was classic, what just happened. What just happened is classic. A lot of people, do this business where you take this and you press Control O, and then I hope I can press Shift Control O to get it back, and I can't, but they accidentally would make this whole thing really long. So perhaps I pressed Alt O, column width, unhide. Whoops. Alt O. Just a minute. Alt O, column, unhide. Okay. Why it took me 2 times to do that, I don't quite know. But then if you do that, I'm not sure exactly why it happens, but it happens to me sometimes as well. Somehow we get numbers in here. And then you better press Control minus and Control S. This makes the models heavy. And I've been noticing, why is this model going slowly? And there perhaps might be another page where that same thing happened. And now we get our equity IRR, and we get a negative number. Now, whenever you do this, I would make a range name on this. I would start recording a macro and call this goal. See, how about LBO? And then when we then you go to the data. What if goal seek set this to 0 by changing the consideration at the top? And now we really have our implied EV to EBITDA from this, and then we can stop recording this. Of course, I should make a range name, but just if we do this right now, at least what we can do is we can start changing some things, and maybe I wish it would automatically go to that. There's got to be a way to do that. Okay, and then we can compute the value. Okay. And then we can say, oh, what happens if we only want 15% return? Then we're willing to pay 10.5. What happens if our holding period goes up to 10? Then we're willing to pay 9.56. Where is our exit multiple? What if our exit multiple is a lot higher? Then we're willing to pay 10.44. So we're really just, in a way, this is kind of uh, not interesting, but it fits the theme. In a way, this whole business of really understanding what the EV to EBITDA ratio really should be, and putting some growth in, and putting this would be putting a high rate of growth and putting some cost of capital in, and then assuming some kind of stable other exit value, which could be a little bit tricky, but it's certainly analogous to our first little exercise. The big deal is this is kind of an arbitrary number still, okay, and this number depends on all the really the growth rate, and we can't see what kind of return we're making, and we can't really see if we've got some kind of wacko assumption in here anyway, and it depends as well a great deal on what kind of financing you have. So if we also change the this, let's make this 8 times debt financing, and let's make this a 5% rate, and then we can recompute the value. Then we'd be willing to pay 11 times EV to EBITDA. So that's the third valuation. So if we combine the rest of the analysis, so far we've got I'm sorry I'm reviewing this and repeating myself. So far we said let's start by understanding ROIC. Then let's understand what sorts of things can change the EV to the EBITDA ratio compared to the PE ratio. Then we did a PE ratio exercise to make sure we understand that the PE is really driven by changes in the growth rate, increases or decreases in the return and the cost of capital. Then we said, well, when we look at EV to EBITDA ratio, it's a lot more complicated than that, because we also have to consider not only the changes in return and the growth, we have to consider things like what the asset life is. Uh, when I change this, I should have told you there's a little data table here in this analysis, and when you change this, I had to compute the ratio of the capex to depreciation that stabilizes, and we needed a data table to do that. Okay, I'm going to come back, like I told you, and uh, explain this one a little bit better in a whole nother video at another time. Okay, and then we said, well, the real economics of a merger come from buying something at the higher price and having a strategy. So we really should talk about exactly how we'd value any kind of future cash flow with different growth, with different discount rates and all that. And then we did that. And then we said what we could do is this thing. This is just frustrating to me. Okay, this one, the blah, 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 blah. Okay, this one, then we said, okay, we can do an accretion and dilution analysis, which is kind of a little bit iffy because it's distorted by the PE ratios of the acquiring relative to the acquirer, and that's going to be in any kind of financial model you do. That effect is always going to be there, especially when you're financing with equity and a share exchange. And we said, no, we could still apply this, but when we take our company, we could really look at how we're financing this investment, and we can really see that if we have a lower return, we have dilution, and what kind of return do we need, and what kind of growth do we need to make this whole thing work. Okay? Uh, 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 and and that depends on your company's uh, uh, the acquiring company's earnings over time. And then we did our LBO analysis, and we just did the same thing. This is really probably most like the DCF analysis out of all of them, because we basically just put a period. Uh, uh, we called it a holding period, and instead of an explicit period, we call this a terminal. We call this an exit value instead of a terminal period. I know I'm repeating myself. And the big variables here are the EV to EBITDA. How much are we paying? How much are we selling it for? How can you justify this? How can you justify this? How can you get the synergies to increase this EBITDA? What should the capex be to make a reasonable return over the long run? How much do we have to invest in working capital? And then we should set up our our uh, our sources and uses assumptions, and then go down, and we can make a little goal seek to make it all work. Okay, so that's part three. And now I'm really just going to hopefully make one more part, and that's going to be our DCF model with some a little bit trickier issues. And I'm going to really, in this DCF model, discuss a little bit on how to do some tricky things with changing the timing, and very much most importantly, uh, discuss the terminal value and how we make the terminal value. And I was wrong, because after that, I'm going to even discuss the cost of capital in an M&A and MBA, and I'm going to really try to tell you the danger of this unleveraging and releveraging the beta, and doing a little bit of a better analysis on this, and then I'll be finished with the review of this class.